here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing and finance. My name is Jason Rivera. Welcome to Value Investing in Your Car.
Hey, Jason here. In this episode of Value Investing in Your Car, we are again not in my car. We are in my lanai, my outside office that I use when it's nice here at my house. My oldest daughter is not in school, so this is why we're improvising and going this route. And again, I'm making client videos. If you didn't see our last week's video, making client videos right now, taking a break from that to create this video for you. So that's why I'm wearing the headset and the microphone. So probably about a month ago now, we started a couple months ago now, we had a series of the 4 most useless investing metrics in this kind of bigger value investing in your car series. We did a little mini series on the 4 most useless investing metrics. After that, I was reminded of a post that I wrote on Quora a few years ago that asked if you could only rely on 3 investing metrics for your entire analysis, for the whole analysis, what would they be and why? We've already talked about, what did we already talk about? So we've already talked about free cash flow to sales and why it's so important, why I rely on it so much, why I think it's such a fantastic metric, what it shows, the multiple things it can show you, all of that kind of stuff. Why it's one of the 3 metrics, not only if I can only rely on 3, but would it be one of the most important ones that I rely on, but why it's still, in every analysis I do, it's one of the most important metrics I look at. Today, we're talking about ROIC, or return on invested capital, and why this is so important. So, first off, ROIC, again, return on invested capital. You can calculate this number many different ways. The way I calculate it is, in my opinion, the most conservative. Essentially, you take EBIT, which is operating earnings, operating margin, operating income, same terms for the or different terms for the same thing, divided by shareholders' equity, which is the amount that's left over after you subtract assets from liabilities on the balance sheet. The money that's left over kind of technically for shareholders. That's why it's called shareholders' equity. Then you add, what do you add? You add in debt, short and long-term debt, subtract cash, and then you add that up, or sum those together, divide the EBIT by that, whatever that number that is, and you get the ROIC percentage. The higher the number, the better, pretty much always. The only time it's not necessarily great is if the company has a lot of goodwill. I don't subtract goodwill from my ROIC calculation, because I want the most conservative number possible, and if you leave that number in there, it's going to be more conservative. So, because you add that, so it makes the denominator bigger when you compare it to the EBIT. So, I want to be as conservative as possible in everything as a deep value investor, not just when it's convenient for me. I want to be conservative. I want to know kind of the base level of everything, whether it's valuation, whether it's investing metrics, whatever it is. I want to know the kind of the base level. If in worst case scenarios this company does this, I want to know the number. So you get that number. The higher the better. Again, only time it's not better is if their goodwill is a lot on the balance sheet. You need to figure that out. If it does make up a lot of the balance sheet, you need to note that. Other than that, goodwill or ROIC, You want it higher the better. I look for anything over 10% on a consistent basis. Why? And why is this number so important? This number is so important because it allows you to see, again, base value investor, we typically value a business first, or at least we figure out our margin of safety first from the balance sheet. If a balance sheet is healthy, if a balance sheet is strong, if it has enough, if it's healthy, it has a lot more assets than liabilities. What are liabilities? What are the assets? All those kind of things. This goes in this entire calculation. This is why it's so important. So, sorry, I just got a notification there. So what we're essentially doing with the ROIC is we're taking EBIT, which is operating profit, dividing it by the balance sheet, kind of leftover balance sheet value when considering cash and debt, and dividing EBIT by the balance sheet value per se, just to make it easy to understand. What we're doing here is figuring out what percentage a company is, or what kind of profits in percentage terms a company earns based off its balance sheet. Again, we want to know this number because as deep value investors, that's where we first look at the balance sheet. So we want to know how much profitability a company produces based on that balance sheet. So it can tell us if a company's balance sheet is strong, because we have to look at the balance sheet. It can tell us the percentage of profits a company produces from its balance sheet, which obviously we'll want to know, because the higher margins the company has, the more likely it is to continue those higher margins, the more likely it is to possibly have competitive advantages. And also, third reason, this is one of the most important ones, is it tells us if a company is investing their capital, in this case the balance sheet, well or not. If it's over 10% on a consistent basis, and I look 5 to 10 years back, then I put that in the good to great business category after my 11 plus years, whatever it is, and thousands of companies research. By anecdotal evidence, if you produce 10% or above ROIC on a consistent basis, that puts you in the good to great business category. Meaning, again, you might have some competitive advantages. You might have some operational advantages. You might have superior management. You might have patents. You might have processes that help you earn these extra profits. Because typically, I mean, profitability on ROIC terms is below, I would say, probably anecdotally under 5%. So essentially, from every dollar of profit you produce, you're only earning 5 cents. Again, the higher the better. If these margins are lower on a consistent basis than 10%, and it fluctuates. I mean, there's nuances to all of this. I've invested in companies. I actually am invested in companies right now that have ROICs lower than 10%. But there's other extenuating factors, like their management's spectacular. Their balance sheet, there's such a margin of safety with the balance sheet that the valuation becomes a screaming value. They may have some kind of patents or competitive advantages. They may have operationally been great for a long time and their profits may have just dropped. Whatever the reason, there's nuances in all of this. I'm just kind of telling you the general kind of rules I follow. But if a company's margin is under 10% on a consistent basis, this is another reason we use this metric. There's a saying by Warren Buffett: you need to find a company that a gorilla or monkey could run. I think that's what the quote is, because some days they will. If the company can run on with 10% plus competitive or ROIC on a consistent basis, essentially, again, it's a good to great business, but a proverbial monkey or gorilla could run it because it's running so well. Again, obviously, higher the better. So what does that mean if it's not 10% on a consistent basis? Frankly, it's a sign that either the management's doing a poor job allocating capital, investing that capital, return on invested capital. They're not using their balance sheet as well as they should. Again, return on invested capital. They may not have any competitive advantages. They may be in a super tough, super competitive industry. those kind of things. So, and people always tell me that, or I get the question all the time that how do you evaluate management? This is one of the first steps I use to evaluate management. Again, it doesn't tell you the whole story. You have to get in the footnotes and the proxy statements and the 10Ks and the 10Qs to kind of get the full picture going back years and decades. But it's a first start on what the company is doing. Again, at least in terms of profitability metrics. So, this is the second metric in this series that is the most important. If I could, or let me rephrase, if I could only rely on 3 metrics, these are the first 2. Free cash flow to sales, we talked about it a few weeks ago. ROIC. ROIC, again, if you are forced to look at the balance sheet, you get an idea of the balance sheet strength, their cash position, their debt position, their amount of goodwill, if their AR is rising and not in proportion to their inventory, which may lead to problems. You get information on their management. You get information on a whole host of things. All these metrics I use, and I was explaining this to a student the other day, that it's literally following the clues on a treasure map is the way I look at going through financial statements, and that from finding a company to doing a preliminary analysis on it to reading its financials to and on and on and on. It's literally you're just following the clues. And this is one clue in the piece of the puzzle that is ultra important because it tells you multiple different things, or it can tell you, if you know what to look for, multiple different things about the company. And that's what free cash flow to sales does, and that's what the next metric will do as well. And that frankly, in my opinion, hardly anybody ever talks about the next metric. And it's one of the probably the single most important metric I look at, especially for most companies. It's not useful for all companies, but for most companies, most normal companies, it's probably the most useful metric I look at. So we'll talk about that next, or in the next video of this little mini series. If you have any questions about anything ROIC or free cash flow to sales, let me know in the comments below. I love talking about this kind of stuff. I actually, with several of my students, we talk about this kind of stuff probably, frankly, until they're sick of hearing about it, because that's how important it is. I believe in setting the foundations of something strong so you don't have to look it up anymore. You know exactly when you see ROIC 7%, you know what it means. I believe in building the mental models and the foundations up so strong that, again, free cash flow to sales at 7% again, I know what that means. Same thing with this next metric. Or if you don't know specifically what it means, let me rephrase that again. You know what it means right off the bat, but you also know where to look for the other clues right off the bat, which is again where the nuances come in. Saves you a lot of time with dealing with crap companies. Helps you find great companies faster. These 3 metrics all do the same thing. They help me eliminate companies faster that are crap. They help me find great companies faster because I'm spending less time on these crap companies. So I hope you're finding some value in this series. Again, if you have any questions about ROIC or free cash flow to sales, in the comments below, let me know. And I believe later this week on the blog, if I'm remembering correctly, there's a training session I do on ROIC that's going to be released on Friday for one of my masterclass students, an extra free training session. So if you're interested in ROIC and seeing the exact calculation, hearing more about it, and hearing kind of where I look for certain things when I find certain things, make sure to watch that video on Friday and subscribe to the blog, because you'll get it. Every blog subscriber gets these videos for free every week. On Friday I send out all the weeks past, or all the past week's content in one email. So you want to make sure to subscribe and watch that video as well. Again, that's Friday. I'll release that at I release all these blog posts at 10 a.m. Eastern time. So there will be, or there should be, if I remember correctly, if it's not this week, it's next week, a video free training session. I believe it's about 20 minutes long about ROIC, all its nuances, again, all those kind of things. Before I get off of here, I always get this question every single time I talk to a student or somebody, why do I use multiple profitability metrics? Free cash flow to sales, ROIC, ROC, unlevered return on net tangible equity, because they tell slightly different stories of or you get to view part of the story from a slightly different perspective. Free cash flow to sales, that's pretty much just top line revenue. Free cash flow, what's left over. ROIC, mostly focused on the balance sheet when compared to EBIT and operating profit. ROC is a slightly different version of the balance sheet. And unlevered return on net tangible equity. Again, we'll talk about all these metrics at some point. But I always get that question, why do you rely on multiple? Because there's multiple sides to the story. I want to know kind of the whole story. And by looking at each, you get the whole picture, in my opinion. Also on Friday, in that post, I talk about why I don't use CROIC. If you've ever come across or used that metric, I talk about why I don't use that in the free training on Friday as well. For now, this video is longer than it usually is, so I apologize for that. But it's a very important topic, and I wanted to talk about all that and remind you of the video if you were interested in this on Friday about ROIC as well. So make sure to check out our other videos in this series, left, right, below, depending on where you're watching this. We talk about these kind of things, the most useful investing metrics, the most useless investing metrics. I do book reviews. We talk about all this kind of stuff in depth, easy to understand ways, hopefully. We've got other series, case studies, preliminary analysis case studies, basic value investment finance, value investing education. What else? We got a bunch of other series as well. Free training Fridays. I talked about that already in this video. So if you want to see our other videos, make sure to go to our YouTube channel. And if you like this video, make sure to subscribe on YouTube and hit the bell so you're notified anytime we release a new video. We're making new videos every single day, and we're going to keep going. We're going to keep going with this and keep giving away a ton of free value, free content to help you learn faster, because I didn't have anybody to help me, and I want to help you. So now that I have the knowledge, I want to help you reach your goals faster than I reach mine. It's taken me 11 years, almost 12 years to get to this point. And frankly, I wasted years of time because I didn't have anybody to help me, learning from crap information, learning from information that was useless, that played no point whatsoever. So I hope you find a value in all these. If you are, let me know. And again, if you want to see the video on Friday, make sure to either come to the blog on Friday about ROIC, the free 20-minute training video about ROIC. Make sure to either come to the blog on Friday or subscribe. Make sure you get all our content. You also get 5 free gifts if you subscribe for free. It's free to subscribe. You get 5 free gifts, and you'll get all of our content. Yeah, pretty much it. You'll get all of our content. So every week we do 5 blog posts a week. We send out stuff on Facebook every day. You'll get all that if you subscribe for free, and 5 free gifts as well. So that'll help you become a value investor, better value investor faster. So hope you enjoyed this content. If you did, let me know in the comments below. Let me know your comments and thoughts on ROIC below. And I will talk to you in the next video. Thanks. Bye.